This LOS is calculate and interpret the cost of equity capital using the capital asset pricing model approach, the dividend discount model approach, and the bond yield plus risk premium approach. So now we're moving on how to calculate the cost of common equity, and as the LOS says, there's three approaches. One is using the capital asset pricing model approach. Two is the dividend discount model approach, and then finally there's the bond yield plus a risk premium approach. We're starting here with the capital asset pricing model, and I just want to show you that if you flash forward to the portfolio risk and return part 2, there's three LOSs with regards to CAPM. One is to explain the capital asset pricing model, including its assumptions and the security market line. But more importantly, there's an LOS to calculate and interpret the expected or required return of an asset using CAPM. So that's the exact same thing that we're doing here in the corporate finance section. And then finally, there's an LOS to describe and demonstrate applications of the CAPM and the security market line. So here's the formula for CAPM. The expected or required return on an equity stock equals the risk-free rate plus the beta times the return to the market minus the risk-free rate, which we call the equity risk premium. So here it is in words. In the capital asset pricing model approach, we use the basic relationship from the capital asset pricing model theory that the expected return on a stock is the sum of the risk-free rate of interest and a premium for bearing the stock market's risk, which we calculate as the beta times the equity risk premium. A risk-free asset here is defined as an asset that has no default risk. A common proxy for the risk-free rate is the yield on a default-free government debt instrument. In general, the selection of the appropriate risk-free rate should be guided by the duration of the projected cash flows. If we are evaluating a project with an estimated useful life of 10 years, we may want to use the rate on a 10-year treasury bond. So that's really important because sometimes in a question, they'll give you a project with a certain duration, say it's 5 years or 10 years, and they'll give you a couple of different risk-free rates, and you want to make sure that you're going to choose the correct risk-free rate that matches up with the project's duration. So that's the little trick there. So continuing with the cost of common equity, now we're just going to look at a little section on estimating the equity risk premium using historical rates of return. So suppose that the arithmetic average T-bond rate observed over the last 100 years is an unbiased estimator for the risk-free rate and amounts to 5.4%. Likewise, suppose the arithmetic average of the return of the market observed over the last 100 years is an unbiased estimated for the expected return for the market. The average rate of the return of the market was 9.3%. Calculate the equity risk premium. So what we would do is the return of the market minus the risk-free rate. So it's 9.3 minus 5.4. We have an equity risk premium of 3.9. Okay, I'm just going to take a screenshot of my computer, and this is a little bit outside the CFA curriculum. However, Damodaran's data is used, and he does have some writings throughout the curriculum. So I just wanted to show this to you very quickly. I'm at the Damodaran's website, if you just Google search, and then you can go to data, click on the data, and if you click on the current data, if we look at investment returns, then he has a nice Excel spreadsheet here, which if I just going to scroll up again, and you can see that we've got the historical returns on stocks and bonds and T-bills for the United States. He also has country risk premiums as well, but this is for the data for the S&P 500. So you can see starting from 1928, he's got the annual returns on the S&P 500, the 3-month T-bill, and the 10-year T-bond, and then he has the compounded value of $100, and you can download this in Excel spreadsheet if you click on here. Nevertheless, if you just scroll down, you're going to see that we've got exactly what we're talking about in this section of the corporate finance. We've got some arithmetic averages. Remember, this is the S&P 500, this is the 3-year T-bill, and this is the 10-year T-bond, and he goes through how you calculate the annual returns on the T-bonds. It's a little bit harder than calculating the returns on the S&P 500, which is just the price ending price plus the dividends divided by the beginning price minus 1. So the S&P 500 is fairly easy, but when you get into the bonds, you have to look at not only the coupon, but the change in the interest rates, okay? So he's got the arithmetic average, he's got the geometric average, and then here you can look at the risk premiums, stocks minus the T-bills. That's just 11.42 minus 3.46, and that's going to give you the 7.96. Or if you compare it against the 10-year T-bond, 11.42 minus 5.18 is the 6.24. So you can see the different time periods, 1928 to 2016, 67 to 2016, and 2007 to 2016. And you can see the equity risk premium does change over time. So that's a little bit of a nice to know, not a need to know, but sometimes I like to show students where you can look at websites outside of the curriculum and get other data, download the data, go through some of the calculations and help consolidate your learning. So now we're moving on to the second method for calculating the cost of common equity, and we're looking at the dividend discount model based approach. Again, we're going to flash forward to the equity valuation concepts and basic tools, where the LOS is calculate and interpret the intrinsic value of an equity based on the Gordon constant growth dividend discount model or a two-stage dividend discount model as appropriate, okay? So basically I want to show you this formula that P0, the price of a stock today, equals D1, the dividend in the next period, divided by the cost of equity minus the growth rate, okay? So that's your basic dividend discount model. And over here, it's just being shown in a different nomenclature. The value today is the dividend today times 1 plus a growth rate divided by the cost of equity minus the growth rate, which is D1 over cost of equity K minus G, or sometimes you see it RE minus G, okay? So then in this LOS, we want to be calculating the cost of the common equity. So we just do a little bit of algebra. We want to take the cost of equity from the denominator here and make it so that we're calculating it. So just with a bit of algebra, the cost of equity is the D1, the dividend in the next period, divided by the price today. You see that? That's important, plus the G. So that's absolutely a formula that you have to be able to memorize. One is P0 equals D1 over, sometimes we see it as K minus G. And therefore, if we want to calculate the cost of equity, it's going to be D1 again over P0 plus the G, okay? So those two formulas, you have to be on top of it. So the cost of the equity capital is the dividend expected in the next period divided by the current price plus the assumed constant dividend growth rate, which is the sustainable growth rate. So let's just do a quick practice question to test ourselves on that. Using the dividend discount model, what is the cost of equity capital for Zeller Mining if the company will pay a dividend of Canadian dollars $2.30 next year, has a payout ratio of 30% and a return on equity of 15% and a stock price of Canadian dollars 45? Is the cost of equity A, 9.61%, B, 10.5%, or C, 15.61%? Okay, this is an excellent question, and it's maybe introducing a topic that you haven't seen yet, and it's how we calculate the G. Nevertheless, we'll jump into it and you'll learn something. So we're asking here for using the dividend discount model, what is the cost of equity? So the first thing to do is always to write out the formula. The cost of equity is going to be D1 divided by P0 plus G. Okay, we have to have that formula memorized, and then what we're going to do is we're going to fill in what they've given us and then solve for what we don't know. Okay, so the D1 we have, it's giving us a company will pay a dividend of $2.30 next year. So we've got the D1, we've got our $2.30, and we have our P0. The stock price is $45 right now, so we're going to do divided by 45, but then it's going to be plus the G, okay? And that's what we don't have. We don't have a G, but it's giving us a return on equity of 15%, okay, and a payout ratio of 30%. So this is a very typical CFA 101 type question where you have to make a little subcalculation. We know the calculation for the cost of equity, D1 over P plus G, but they're not giving us G, but they're giving us some data that we can calculate. So G, this may be new to you, equals the retention rate times ROE. Okay, you're going to see this quite a bit throughout the rest of the program. The sustainable growth rate is the retention rate of the dividends times the ROE, which makes sense. And so they're giving us the retention rate. They're giving us the payout ratio of 30%. So the retention rate would be 1 minus 30%, so it would be 0.7 is the retention rate. And they're giving us the ROE of 15%, so it'd be 0.7 times 15. So if I just bring up the calculator, 0.7 times 15, we're going to have a G of 10.5%, okay? So now we know we can do our calculation. It's just $2.30 is the dividend, D1, divided by P0, which is 45. That gives us 0.05111 plus 0.105. And so we're going to have 15.61%. We can see that the required return for the equity is 15.61%. So a very nice question. The only thing that we learned now is that to calculate G is the retention rate times the ROE. So set up your formula, put in what you know, solve for what you don't know, and then solve the question. It's kind of a two-step question. Okay, I have a slide here that you're going to see a couple of times. You see it here in the corporate finance section, and again, you're going to see it in the equities. So we're looking at the cost of common equity, and we just saw on that last slide that the cost of the equity equals the D1, dividend in the next period, divided by P0, the price today, plus the G. But we needed to calculate the G, and so I said that G equals the retention rate times the ROE, and G is the dividend growth rate, the sustainable growth rate, and the retention rate is often given by the symbol small b, and that's the earnings retention rate, or retention rate, which is 1 minus the dividend payout ratio. So often in questions, it'll give you the payout ratio, and you got to calculate the earnings retention rate. So again, you can see 1 minus the payout ratio times ROE, and we see the same formula written different ways in different texts, so you just want to be careful with that. But basically, G equals retention rate times ROE, and the retention rate is 1 minus the dividend payout ratio, and the dividend payout ratio is the dividend divided by EPS. So again, they can give you some data, and you need to calculate, you need to make some sub-calculation. That's very common. Then when we get into the ROE, remember from the DuPont back in the accounting learnings that ROE is the return on equity, which is net income over equity. But using the DuPont, we can expand that to ROE equals the ROA times the leverage. So remember, ROA, net income over assets, and leverage, assets over equity. If I scratch out the assets, I'm back to my net income over equity. So expanded DuPont, the first level, ROE equals ROA times leverage. And then finally, when we go to the next level, we can expand it to profit margin times asset turnover times leverage, net income over sales, sales over assets, assets over equity, okay? And if we scratch all that out, we can see we're back to our net income over equity. So this is just a useful slide. We're going to see that in corporate finance. We're going to see it again in equities. We see the DuPont back in the accounting. It's a common theme throughout the CFA. You need to be up to speed on, given some data, it's like little problem solving, little puzzle solving. Given some data, do the sub-calculations, get what you need, use that in your formula to solve ultimately what you need for what the question's asking, okay? Okay, so now we're continuing with how to calculate the cost of capital, and now we're going to look at the bond yield plus the risk premium. So remember, we started with the CAPM was the first method, which the expected return to the required return to the equity is the risk-free plus the beta times the return to the market minus the risk-free rate, and we call that the equity risk premium, okay? The second way was the dividend, spinning the dividend discount model. The dividend discount model, P0 equals D1 over cost of equity minus G. So we can spin that RE equals the D1 divided by P0 plus the G. You have to have that memorized. And now finally we're into the third method, which is the bond yield plus a risk approach. So the cost of equity is the cost of the debt plus a risk premium. So the bond yield plus risk premium approach is based on the fundamental tenet in financial theory that the cost of capital of riskier cash flows is higher than that of less risky cash flows. In this approach, we sum the before-tax cost of debt and a risk premium that captures the additional yield on a company's stock relative to its bonds. So again, the only thing you need to be careful of is if they give you the after-tax cost of debt in the question, you need to put it before tax, okay? So again, bond yield plus risk approach is pretty easy. You're just taking the bond yield before tax and you're adding a risk premium because stocks are more risky than bonds. So we're just going to finish this LOS with a practice question as we often do. A financial analyst at Bucko Limited wants to compute the company's weighted average cost of capital using the dividend discount model. The analyst has gathered the following data. So the before tax cost of new debt is 8%, the tax rate is 40%, the target debt to equity ratio is 0.8033, the stock price is $30, the next year's dividend is $1.50, and the estimated growth rate is 7%. Bucko's weighted average cost of capital is closest to A, 8%, B, 9%, or C, 12%. Okay, this is an excellent question to end on because we have to solve the question fairly quickly, so we got to know what we're doing and go through the steps fairly fast. So it's asking us to calculate the weighted average cost of capital, so we need to calculate the cost of equity first, and it's telling us to use the dividend discount model, which is a help. Sometimes they may not even tell you which model, and you just have to look what kind of data is being given to you. In this case, you can write out right away. The cost of equity is going to be D1 over P0 plus the G. And in this case, they've given us all that data. The D1, next year's dividend, is $1.50, and they're giving us the price today is $30, and they're giving us the growth rate of 7%, 0.07. So if I bring up my calculator, we can see that $1.50 divided by 30, okay, is going to give us 0.05 plus 0.07, and I'm going to have 12%. So the cost of my equity is 12%. So that calculation is fairly easy. RE is going to be 12%. They gave us all three variables to solve the equation. We didn't have to do any subcalculations on G. We didn't have to give any subcalculations. Sometimes they'll give us D0 and a growth rate, and you have to remember it's D1. But that was fairly straightforward. Now, again, the question is asking for the weighted average cost of capital. They're giving us the before tax cost of debt, and they're giving us the tax rate. But what is our weight of the debt? The weight of the debt, they're giving us the target debt to equity ratio of 0.8033. So remember, from a couple of LOSs before, that was really important. To calculate the weight of debt, we're going to do the debt to equity ratio over 1 plus the debt to equity ratio. Okay, that was the key thing that you had to remember to get the weight of the debt. So in this case, we have our numerator, 0.8033, and 1 plus the debt to equity is going to be 1.8033. So if I bring up my calculator, again, I'm just going to move it a little bit to the right so we can see our calculations. 0.8033 divided by 1.8033, and that's going to give us a weight on the debt of 0.445. So it's okay, we can do a little bit of rounding always. So our weight of our debt is 0.445. Okay, so we know our weight of our equity then, if we just make that a negative and we hit +1, the weight of our equity is going to be 0.554. Okay, so the weight of the equity equals 0.554. And then we're going to solve the weighted average cost of capital, which is the weight of the debt, 0.445, times the cost of the debt, 0.08, which we've got, times 1 minus the tax rate, plus the weight of the equity, 0.555 or 554, doesn't matter, times our cost of the equity, which we calculated as the 12%, and we're going to get 8.8%. And again, this is an excellent question because it says closest to. You've got all the 8s there, 8.8. You have some people that might circle A just because they're fixated on the 8, but no, it's closest to 9%. And that's why you have to be careful when they're using these closest to. Just pay a very close attention to the detail. 8.8 indeed is closest to 9%, so the correct answer is B. So that's a fantastic question to finish this LOS on. You had to go through all the paces in terms of calculating the cost of equity using the dividend discount model. You had to calculate the weighted average cost of capital, and you had to remember how to calculate the weight of the debt given a target debt to equity ratio. And that's the last slide for this LOS. Thank you.